Let's get back to the economic implications of a potential impeachment now and what a stimulus situation could look like in this next Congress. Joining us now is Joe Brusuelas. He's RSM chief economist. Joe, it's great to see you. Happy New Year. I don't know if we've seen you in the new year yet. It's been like 3 months in the new year already, so it's tough to say. So, talk to me about this impeachment battle here and if it has some implications for the economy, because it might have implications maybe for a stimulus package.
Well, I think that the second impeachment of President Trump has little direct impact on the economy. Most of it's indirect, and we're seeing some volatility across equity markets this morning. But let's be brutally honest about what we're seeing. If the share prices of Facebook and Twitter fall, that doesn't mean a lot. These are advertising platforms. They have very little economic meaning. While we have exposure, perhaps direct or indirect exposure through our portfolios, but there's not a lot there. What I think this likely does, though, is the events of last week will probably lead to a period of détente between the parties. And it probably increases the probability, let's say, of a much larger fiscal aid program early in the Biden administration. And then based on what I saw over the weekend and what I'm hearing, I think we're setting up for maybe a $2 to $4 trillion stimulus and infrastructure package early in 2021. And all of that should be good news to investors, forward-looking firm managers, and policymakers, because we need to modernize the infrastructure of this country. It absolutely has to happen. And with the 10-year interest rate sitting at 1.1%, in real terms, that means it's got a negative handle on it. This is exactly when you want to make long-term strategic investments.
Joe, speaking about that, the size of that fiscal impulse that you just outlined there, certainly the market would like to see that, and I think has been anticipating that to some extent. Are you concerned at all, though, about what we're seeing in the early process of the vaccine rollout? Because I think that has also been taken somewhat for granted by the market, that it would go well. We'd have tens of millions, hundreds of millions of vaccinations by maybe Q3. But the current pace certainly is discouraging at the very least.
Okay, yeah, it hasn't been handled well, and that's putting it mildly. We could use much stronger language, but that's not suitable for a family network like Yahoo Finance. Yeah, it's going to be one of the risks in terms of the economy in the first and second quarter of the year. But based on what we're hearing, I'm pretty certain that we're going to see a much more robust rollout and participation by the federal government in cooperation with the states to get it there. I'm here in Austin, Texas. It's where I've been riding out the storm. We're going to phase 1B today. So it's just not 65 and older. It's 16 and older, and anybody who's got a condition that's at risk linked to the pandemic. So in very small terms, we're making progress there. And it's really important when we're in public forums like this that we note that, because things have been so mishandled and things have been so bad for such a long time. I think the default position is, well, this is all just screwed up. Okay, sure, I'll concede the argument to you, but I can tell you today here in Texas, sun's come up, things are looking.
Joe, absent a new round of fiscal stimulus in the first several months of this year, what's the downside risk to the U.S. economy in terms of GDP?
Okay, well, we got at least enough fiscal aid. By the way, there's a real difference between fiscal aid and stimulus. As I've talked to the media the last couple of days, I want to put something out this week on that, because that fiscal aid that was put forward, the $908 billion, that was sufficient to avoid a second downturn in the first quarter of the year. So when we look at where we're at now, if there's no further stimulus, that's about 1.1% growth in GDP during the first quarter of the year. But because I'm expecting at least another trillion, maybe more, we're going to be revising up that forecast of this week. And we're really looking at more 2.3 to 2.5% growth here in the first quarter, just due to the fiscal aid program that's been put forward. And the second, there are the next round of fiscal aid that's going to be put in place. And then this is important. There will be stimulus. It will be coming, but it won't look like what we've seen. It'll be somewhat different.
Joe, as we have the stimulus track on the one hand, there's another potential sort of long-term demographic headwind for the U.S. economy, and that's slowing population growth. Axios putting out an interesting chart this morning. They looked at census data, crunched that data, and said America's population has grown at the slowest rate since at least the 1930s. So, given that, how much of an obstacle is that going to be? I mean, even once we get past the pandemic, which has been a factor in that slowing growth, but it's not the only factor. So, how much of an issue is that for economic?
Okay, if you leave that in isolation, that is a drag on overall growth, as growth in the labor force has declined from, say, its traditional 1% to less than 0.5%. That's where the real problem is. Now, one of the unintended consequences of the pandemic is it's pulled forward the substitution of technology for labor. I mean, think about what we're doing here, Julie. Instead of sitting next to you at the desk in New York, I'm talking to you via Skype. I've got a high definition camera. We've got microphones. I've got my data in front of me. We're able to do these things in different ways. And as companies, and this is what we're hearing from our clients. And this is, my clients are not big banks. My clients sit on Main Street. It's the real economy. They're pulling forward about 10 years worth of technology inside 10 months, right? That's going to be a game changer, right? And so as we integrate the more sophisticated technology into the production of goods and the provision of services, that should tend to offset somewhat the drag from a declining increase in the labor force. It also augurs for looking at immigration policy in coming years, because we're going to absolutely have to import people from the world to do some of our work that we just don't have enough workers to do. And that may sound counterintuitive with the unemployment rate at 6.7%, right? But you look over the horizon, we're just not producing enough domestic labor to meet demand. So a combination of immigration, a combination of technology, and of course, given what we've seen in the country, for some, those may be fighting words, and I understand that.
Yeah, that's going to be really interesting too, as it plays into what the Biden administration will do on immigration policy. Joe, always a pleasure to talk to you. Joe Brusuelas, RSM Chief Economist. Thank you so much. Appreciate it.
Thank you.